Hey everybody, welcome to Strategy Now here at MarketStream.live. My name is Joseph Cusick with the Cusick Group, securities offered by MoneyBlock. Well, it's a grinding market here, continues to be today. And so if you're a position trader, you're frustrated. You've seen a market for the last couple of weeks stay in a very tight range. If you're a swing trader, you've seen a very tight range, frustrating. So I thought, well, why not talk about a strategy that has low probability of profit, but it also has a low risk factor, and it's called the iron butterfly. And I'm going to look on the spiders. The reason why is volatility has spiked quite a bit. And historically, when you see volatility spike like this, it does what it did in the past, which last week or a couple weeks ago, when it went as high as 15 and some change, it actually collapsed and basically went back into the 12 to 11 range. Now with volatility at 15.7, 1570 up 60 cents, obviously a lot going on in the world. I thought, why not put a low risk, but because it's low risk, low probability type position on the spiders. Now the spiders could get directionally biased, and so with that being said, the caveat is that there's a breakout either to the upside or to the downside. So we want to basically cap our risk in either direction, but take advantage of this high implied volatility. And one way that you can do it is in a strategy called an iron butterfly. Now, for those of you that have never traded an option spread, no worries. I'm going to show you how this lines up. We're going to actually look at the May expiration cycle, the monthlies right here. And we're going to look at the monthlies because it gives us a maximum amount of time, about 39 days to be right. And basically the way the iron butterfly works is that you're selling the at the money straddle. So with the underlying trading at 234 basically, that's where the spider's 234.37. I'm going to look to sell the 234 calls and the 234 puts. Now, if you combine both of those, you're basically taking in almost $8 in premium, about $7.60 in premium, right? Let's see, it's 58. 60, yeah, so you're basically taking in about $7.60 in premium, a little bit less than that's 50 cents. So with that being said, you're basically looking at this and saying, but I have unlimited risk to the upside with these short calls, and I have risk to the downside down to zero. So you basically want to cap your risk off. Let's say 231, so I'm going to buy the 231 calls and 237 puts, and then 237 calls. So now I've capped my risk, 237 to the upside, 231 to the downside. And net, what will happen is that you're going to receive a credit. Now that credit is going to be a culmination of what you're selling and what you're buying. And at this stage, you basically can take a credit of $2.63. That's where it's currently bid. Now the difference between the strike prices is $3. So your maximum risk is $3 minus the credit you receive, which is $2.63, which happens to be 37 cents. So you're collecting $263. Your max risk is $37. That's if at expiration in May, that if the stock is trading at or above 237, you're out 37 bucks. If it's at or below 234 at May expiration, you're out $37. Now you're receiving a big premium, which is why you have a low probability that this is going to be profitable. One thing that I would mention is that this is going to be managed very tightly. So if I'm doing one contract, I'm going to have the potential to make $263, and my risk is 37 bucks. That's why you have such a low probability of success. The probability that the spiders are going to be exactly at $234 at May expiration is no better than flipping a coin. As a matter of fact, it's a lot worse. There's only about an 18% probability that you're going to have some sort of profit in this trade. But with that being said, let's say over the weekend, North Korea decides that they are no longer going to use nuclear weapons. The United States and Russia decide that they are going to back off from each other. The Cold War is not going to begin again. And the Syrian conflict starts to at least lessen in its veracity as far as the volatility that we're seeing there due to the fact of the unconventional and brutal tactics that are being deployed there. With this all being said, volatility could go from 15 to 12, which means that this spread could collapse or come in quite a bit, because you can see these at-the-money options are pretty skewed up. As a matter of fact, the implied volatility on these is at a rank that we haven't seen in months. So the bottom line is that we're going to try to take advantage of, and I'm going to do this for credit, we're going to take advantage of that escalated implied volatility, knowing that we're going to manage this. So, for example, the maximum profit I can make is $263. If I recognize a 25% profit sometime next week, in other words, I see that 25% of the credit has already come in. That's roughly around what on this spread at 263, 25% is going to be roughly around $60. I would pull this trade off and collect my $60, right? And while some might say, well, $60 isn't a lot of profit, well, it actually is, because I only had $37 worth of risk. So basically, if you look at it from a risk reward, I'm doubling what I actually was risking. I like it. All right. So bottom line is that I'm selling the 234 calls and puts. I'm buying the 231 puts. I'm selling the 237, buying the 237 calls, cap off my risk. My reward is 263. Now, of course, I'm most likely not going to hold that. It's trading at 262. I'll be patient. Bottom line is that you will look once and if you are filled, you'll look to cover this probably when you get about 25% of the total credit received in, and that'll hopefully be after a contraction in volatility and the market continues to grind over the next week or so. The probability of that occurring, very low. As a matter of fact, going into the May expiration cycle for the spiders, the estimated move is around $7. So that's why I said this is a low probability, but also a low risk type of strategy to deploy. And it also keeps you engaged. All right, folks, that's it for strategy now. Join me at 3:30 Eastern Time, where we'll be doing Tech Talk. We'll be talking charts and option analysis to give you an estimated move analysis of going into some stocks that are going to be announcing earnings, as well as just looking at the major indices and kind of looking at where the moves could be over the next week. So see you there.